Hello, and welcome to another episode of Earth911's Sustainability in Your Ear, the podcast conversation with a change maker working to accelerate the transition to a sustainable carbon-neutral society. I'm your host, Mitch Ratcliffe. This is our first conversation of 2023 with Newday Impact Investing, whose CEO, Doug Heskey, has talked with me frequently over the last year. Earth911 and Newday Impact have a special series of programs in store this year that will feature some of the world's leading environmental leaders discussing how we can make rapid changes to business and infrastructure to protect life and the planet. Stay tuned. But today, we welcome Ann Popkin, President and Chief Operating Officer at Newday Impact, to discuss environmental, social, and governance, or ESG investing. More than $8.4 trillion have been invested in ESG-related products as of the end of 2022, according to Bloomberg. And it will be a hot topic for investors, Congress, and the federal government, as well as several southern states, notably Florida and Texas, who are at war with ESG because it represents, in the words of Florida's Speaker of the House, Paul Renner, quote, woke financial titans who seek to dictate policy to Floridians regardless of our choices at the ballot box, unquote. I asked Ann to join the conversation today to get an investor's perspective on the politicization of ESG. Before we start, let's take a moment to define the role of ESG reporting in business, which the Securities and Exchange Commission has proposed will soon be required of all publicly traded companies. An ESG report is not a set of sustainability commitments, though those may be included to show progress at reducing the company's financial risk. What an ESG report focuses on is the long-term financial implications of the company's environmental, social, and governance practices. For example, if they continue to generate CO2 emissions at their current level, could they warm the planet and produce negative impacts that could raise the cost of doing business or interrupt their supply chains? So social issues might include the risks from social conflict in the communities where the company operates, and governance has to do with how transparent the firm is with investors and other stakeholders, which can lead to lots of shareholder liability lawsuits. ESG reports are designed to help investors assess the short and long-term value of a company, as well as its ability to contribute to a sustainable future. There's a lot to cover, so let's bring Ann into the discussion. By the way, you can learn more about Newday Impact Investing at newdayimpact.com. That's all one word, no spaces, no dashes, newdayimpact.com. Welcome to the show, Ann. How are you today?
I'm well. How are you? And glad to be here, and Happy New Year.
Well, thank you. I'm well. It's 2023 has been exciting so far. And I really appreciate you taking the time to talk with us today. I described ESG in the opening, but everyone has their own personal lens on this topic. So I wanted to ask you, how do you explain ESG to your clients or potentially to your parents?
Whether I'm speaking to investors or my parents for that matter, I always emphasize that ESG is a framework for investing, not a product, not an asset class. So we use environmental, social, and corporate governance factors when analyzing companies to find the world's most sustainable companies. We do not exclusively use these inputs at the exclusion of all others or other analysis, such as financial, et cetera. Mm-hmm. But therefore, as an investor, I would say asking the questions we do, what are the risks to companies of their environmental footprint or the methods they are taking to find the best human talent, and the transparency they provide investors of how they're doing this in a timely and accurate fashion is invaluable in determining the likelihood of the greatest long-run value and returns. To my parents, who would want to align their money and with the missions they care about, mm-hmm. and the factors that they can determine whether a company is a positive contributor to the solution of the social and environmental goals they have, while maintaining investment returns. The fact that these two needs can be met simultaneously, so they're not mutually exclusive, is a vital part of investing and the thinking going forward. So ESG is here to stay.
And so really what we're describing is we can now measure a whole lot of other factors that will impact the future performance of the business. Why wouldn't we take those into account? It seems to be the question that is under debate.
Correct. That is exactly the question under debate.
So Deloitte recently found that 99% of public companies expect to invest in their own ESG reporting. Can you tell us what you think the general progress and adoption of ESG reporting is? And do you think there are changes that we need to make to improve the practice?
So I think that the progress of adoption is going well, but we clearly need further. I think the more important need is the latter part of your question, and that is we need better reporting. We need standardization and equally timely and reliable reporting. We need to know the economic impact of these sustainability factors and sort of the materiality of the risks. And how are the company executives and boards involved in the process of oversight? Because change comes from the top, as we know. We need a forward-looking assessment of these risks and opportunities. All of these will make investment decisions for managers like ourselves better. The above is being addressed specifically, actually, in the SEC proposal that will come up for approval soon. It's a critical part of increased corporate transparency, Mitch. It's very vital.
Well, that brings us to the fact that this is now a political hot potato.
I would say.
And a lot of companies simply, well, let me put it this way, maybe not a lot of companies, but there are politicians associated with companies that don't want those companies to be held accountable to report these things. Why has ESG become that hot potato?
I'm very hopeful that the momentum will build here. I think the demographic factors at play will outweigh the politics, especially as the size of Gen Zers and millennials outweigh in the economy baby boomers as they retire, because their demand and passion for services that address these issues is great. But with respect to the politicalization of these, I think any time there's large societal change at play, there's always politics at play. I think we need to look no further than the 60s to see that.
Sure.
These changes require trading the short run for the long run, which is always hard, especially if you're not going to necessarily see the benefits of the change, but then for the next generation, it's critical. And I also think, and you can read Harvard Business Review about change management in companies and other ones for about societal change. Change requires that the pain of the change be less than the pain of where we're going. And each environmental disaster or social unrest somewhere in the United States is assisting in this process. But all of this requires leadership, and this we need more of.
So this is the problem that I struggle with, is I debate ESG with people who are on the other side, and I consider myself a centrist. I live where the middle of the world seems to, at least I hope so. The adoption of ESG criteria by funds, bonds, venture investors, that all feels to me like a market signal that there's something that is valuable here. Why do you think that free market Republicans don't want to respect the signals being sent by investors?
You know what? You got me there. I don't have an answer because it doesn't make any sense to me.
Yeah, so I don't get it.
It doesn't make any sense, Mitch. I think you're right on top of that one. I'm a centrist too, which isn't what's leading politics right now. And all I can say is that social momentum usually brings in large corporate interests and therefore money, and that's political. And I think, honestly, it doesn't matter which side you are on. It's going to be that way, because that's why I go back to one of my original statements, which is, why wouldn't you allow for consideration of these factors, consider it in the framework of investing, and then allow investors, to make a decision, the decision as to whether or not they want to consider these things. I go back to the issues in the politics in Florida, and I would say it's not about my politics, because like you, I'm a centrist. It's not about my politics or the business I'm in as to whether or not I want to say I shouldn't consider these things de facto. My answer is no, because I go by the simple adage that more information is better than less. Information is a competitive edge.
Sure.
And then you just consider it. And by the way, you might even decide to disregard it.
Well, Florida pulled $2 billion out of a BlackRock ESG fund in November. And I guess, in a sense, that's Florida making their own decision. There's a lot of hyperbole around it. But does banning a choice available to a fund manager, like using ESG data, actually increase the risk of loss or slower appreciation of value over the long run?
I think this is a good question. I think this framework and the factors used to help identify some of the world's most sustainable companies, which is what we do, we also select from within them. So I believe it assists in long-run value creation in these companies, and therefore long-run value creation within our portfolios. And I also think it lowers the risk of loss by looking at these things,
right,
because as well. So it's not that other things that you look at, other factors, can't do the same. But I certainly think considering ESG as a framework or a factor within your investing models is good. So it may very well have effect on long-run returns.
Now, again, and this is possibly too loaded a question, but when you strip away the populist hyperbole that you hear around ESG from Ron DeSantis, for instance, the governor of Florida, do you see any substance to their argument that somehow the voters' will is being defied by corporate America?
No, I don't. I think it might be the most important question about the politicalization of ESG. But as I mentioned before, when you strip away political colors and you ask, should you not consider ESG data de facto, which is what you're asking about, my answer is no. This isn't, as I said, because of my politics or my business, but because of this simple adage that you always want more information. Or I maybe should say you always want to be able to analyze information. So why wouldn't you consider all these factors? Why wouldn't you want to allow investors who spend all their time analyzing information to add it to that pool of information? I'm not saying it should be the only information. As I said at Newday, we don't use only ESG data. We use a lot more financial data as well. But to just de facto say you would not want to consider it seems to me to be a bad method of investing.
Well, in fact, it seems to me like it's painting with a broad brush one factor that is being added to the calculus of making an investment decision, rather than recognizing it's just one more factor and therefore an influence, but not the determinant of every decision. And that's also the way that the right has gone after, for instance, affirmative action. So it does sound like a general political strategy to me.
Yeah, I think you're exactly right. Why would you want to just strip out a piece of information from investing? Information is a competitive edge. That's the bottom line. So, it always has been. And so, like I said, even disregarding information is a competitive edge in investing.
This is a great conversation. I want to take a quick commercial break, and we're going to come back and let's talk about how ESG funds and stocks are performing. We'll be right back. And now back to the conversation with Ann Popkin, who is President and Chief Operating Officer at Newday Impact Investing. So, Ann, you all at Newday Impact have a collaboration with UNICEF and Generation Unlimited. And Tarek Fancy, who was BlackRock's sustainable investments leader and is now a fairly vocal ESG critic, works. And you recently had a meeting with Mr. Fancy, who has described ESG as a dangerous placebo that harms the public interest. What were your points in response to his criticism when you talked with him?
We had an opportunity to spend some time with Tariq, and I think what we did was to talk about what we are doing at Newday that's different and more authentic, in our opinion, to try and address some of these issues. We also talked about the challenges of ESG investing in different areas. It was very,
what kind of challenge?
I think challenges of ESG investing come from the fact of some of the previous things we were saying, data and actually evaluating data and getting consistent data across all different corporate entities, right?
Yeah.
So things like this do make, we want to utilize data as the beginning point of authentic investing. We also believe that you need to do engagement is a big part of our investing. So we think it's not just about capital investing, but it's also about it's also for authenticity. You need to have engagement with corporations, and a lot of this is complex. So there are challenges of ESG investing. So we found it very interesting for us, and I believe the exchange was for him too.
You published some notes in your newsletter about that conversation, and one of the issues you called out is, and this is a quote from it: corporations have in many regards supplanted the role of government in looking after the welfare of a community's citizens. And you just called out the fact that a lot of the data that we get is not really comparable, and that comparability is essential to being able to make a good decision. Are corporations too powerful in this context?
I actually think what's happening is an evolution in the corporate role in society, not so much about whether or not their power is too much or too little. If you look and you think way back to corporations, think about corporations that were part of smaller towns where before globalization, in which they supported the local baseball team, in which they took off time and let all to be parts of various things in communities, when they participated in growing gardens as well. So I think that corporations were part of communities, and hence the people and other entities, which you would say was very much a part of local government and activities within the community, has long been a part of corporations' involvement. So I don't know that it's about having more power. I think it's the role they're playing. And that has to do with, in my opinion, the fact that many of these problems are societal problems that are looking to be addressed, and the need for private and public work together to address environmental issues. That's a very strong reason, and that we believe that ESG is a framework, not particularly an asset class of sorts, and that we actually believe that part of investing or impact investing is also engaging with corporations. We think they have a very strong leadership role in these changes.
And it would be, in a sense, foolish to ignore these massive structures. And you point to Walmart, for example, which makes more money than many states, and ignore their potential to be a contributor. And I guess to take a paraphrase from 2001: A Space Odyssey, it's full of people.
Yeah.
And those people have an opportunity to interact with everyone in their community and to become more integrated into the social conversation than they have ever been. And companies might want to treat that as an opportunity rather than a challenge.
Yes. And I think in many cases, I mean, we all know that Europe has been a big leader in some of these spaces. That's exactly what they see it as an opportunity, not a risk. And I think many companies are seeing it that way, where large portions of their employee population are actually putting forth to management areas of concern. And if you think about it, they're consumers. As I said, as Gen Zers and millennials become a much larger force in the economics of in the economy, I should say, they will certainly care about these issues, and therefore how corporations respond, and therefore how they expect the overall world and our nation to be dealing with it. It will have to be their problem. And I look at, excuse me.
Go, please, feel free.
And I think it isn't surprising that because of these things that will impact these companies,
Mm-hmm.
that investors would expect their leaders to be thinking about them. If I just step back as an investor and ask that question, I don't think that that is. I don't think that that is unusual, nor do I think it is. Certainly, don't think it's inappropriate, and actually, I think it's should be expected that an investor would want to know that.
Mm-hmm. Now, you mentioned Europe a moment ago, and they did something in December that caused a bit of a crisis in the ESG investing world. They introduced a new regulation, Article 9, that requires a fund to be made up of 100% sustainable assets. And previously, ESG assets would call themselves sustainable if 80 or 90% of the fund's holdings qualified. This is called Article 9. How did that change the ESG market? And do you see Europe as beginning to take a true leadership position and potentially leaving the U.S. behind in this?
So when I look long run at some of what's being done, let's try to take the end first in ESG. Actually, while Europe is leading the way forward in the financial markets in many ways, the U.S. is actually showing signs of trying to move forward, such as the SEC proposals that are going through. But this along with the crackdown in the U.S. on misleading representation of products to address greenwashing has led to assets no longer being attributed as ESG assets. Right. And some asset managers have reclassified assets proactively. I think this has led to a change over the past year, Mitch, that is short run is leading managers to adjust how they will construct portfolios, but also providing better information. I think most importantly, the mistake here is the fact that they were presented as products in the first place. Yeah. ESG, as I said, is a framework, a factor in investing. And therefore, if it had been better explained to begin with, I don't think we would be here. This type of evolution in industries during large, as I said, societal changes, which is what's driving this, is the norm. And in fact, I actually think this is a good thing for investors to become better informed and ESG to better define itself so it's better understood. I think this will be a step back to take a couple better steps forward, if you see what I mean.
Yeah, an evolutionary process.
Exactly. Couldn't have said it better, yes.
Now, Goldman Sachs did manage to raise $1.6 billion for a new Article 9 compliant ESG fund in January. Did you see that as beginning to restore investors' faith? Because a lot of them had been sort of running away from what were described as ESG products. To your point, that's not the right way to think about it, but they had been running a bit. Are we seeing a restoration of confidence?
I don't know if it was reassuring or restored faith, or merely that it was a reflection that investors never left ESG to begin with, just pulled back to better understand or demand additional information. I think Goldman's understanding was that this was about change around the edge, about information, not about a fact that the core demand remained unchanged. ESG remains and will so. Nobody's leaving ESG. The trend is clear. No big institution that I speak with is turning around on ESG, but they are reflecting on things, asking these questions about how to better inform and better define.
Now, you wrote in early December that the split Congress that was the result of the 2022 midterms, quote, perhaps ensures that environmental and social advancements made over the past 2 years won't move backwards. What's your assessment of the market response to the 2020 midterms? And are you also expecting to see the Biden administration use other regulatory mechanisms than legislation to introduce new ESG-related policies?
So I think the split Congress, as I wrote, given the concerns going into the midterm elections, given what history would say about midterms, and also given the pollsters' prediction of much worse, the infamous red wave. And when I say that, it's not about politics, it's about what that would mean for environment and social advancement, was actually quite good news. The split Congress means that the climate initiatives within the Inflation Reduction Act won't be able to be rolled back. Mm-hmm. So now, as we've seen, states will figure out ways to push their own initiatives. But at a federal level, the programs and most importantly, the money put forth in the bill will continue to move forward. This is critical. They're giving money to companies that are putting forth other means of developing energy, et cetera. So this is critical. I think it will be difficult for large new initiatives, and especially as we know, the courts ruling on the EPA and ensuring that agencies move forward on initiatives that are highly well defined within their purview of what the agency's descriptions are will make it a bit more difficult for that. So I think the key or critical initiatives, as I said, is going to be to not move backwards. And so things like the president ensuring that that we remain in the Paris Climate Accord, that we positively participate in COP28 since 27 was disappointing, that we work globally as well as domestically on these issues because clearly they are international, will inherently move us forward.
You mentioned COP28, and there's some controversy around that. It's going to be the second consecutive COP hosted in a petrostate.
Yes.
And it's going to be chaired by the CEO of a petroleum company, a national petroleum company. Is that a problem? Or do you think that the UN is undercutting its credibility and authority?
I don't.
Okay.
I think it's similar on a governmental level to the exclusionary issues in the corporate arena. Mm-hmm. And I think this is also where you get politicalization of ESG. I think we cannot turn our backs on everybody involved in industries that have long been a part of our economies. And there's no doubt that different parts of the world have greater exposure to that industry for their livelihood. So I think it's incumbent upon us to try and to engage, as I've said, like we believe in corporations, to engage and try to find change. If we look at some of the countries in that part of the world or exposed to this, they are looking for other means, other technologies, other industries to advance their economies into the future. So I think I like to say frequently is that if we turn our back and walk away, we can be guaranteed that our views about change will not happen.
Well, and to a large degree, that was John Kerry, our climate. What the heck is he called?
Ambassador. I don't think
he's our czar, our ambassador.
Yes, I think that's a fair word.
That was his point about the role of I can't remember the gentleman's name in that in COP28, that we need to have that industry in this conversation. Now, when you look at the political situation here and globally, what critical social and environmental initiatives do you think the U.S. needs to put in place in order to take the next step after the Jobs Act, the Inflation Reduction Act, and so forth?
Like I said, I think right now, the next key initiatives, there are many that you can speak to, both on the environmental but also on the social side to move forward. But I think right now, given the situation at hand, there needs to be, to some degree, for lack of a better way of putting it, in all societal change, a pullback and regrouping, right? Mm-hmm. Not a pullback to moving backwards, but what's going on right now, which is defining, educating, and assessing so that you can make that next big step forward. I think there's always upward movement, then there's a bit of a plateau, and then there's another huge upward movement.
Yeah, consolidating what we've learned.
Exactly. And I think that's what's going on here. And I think the split Congress, as I said, actually may be giving us that chance without moving us backward because of the enormity of what went on in the Inflation Reduction Act, because of the fact that under this president, we have somebody like a John Kerry who's out there engaging. Engagement is a huge part of forward momentum, is that as we were just discussing, we need to do that to find a forward movement. And so a lot of these new technologies that will come up, as well as engaging to find change, that will be the next big step forward.
What does Newday Impact see in terms of ESG funds performance and capital inflows in 2023 then? I mean, and getting close to wrapping up this conversation, but do you see more progress in 2023, or do we see sort of a pause as a result of what that consolidation requires us to do?
I think this is a really important question because I think what happened this year, made people question some things. I think this was clearly a pause, not the beginning of a long struggle. Performance this past year was driven by macro and geopolitical factors. The considerable rise in interest rates to fight inflation and the war in the Ukraine, driving oil prices sky high, affected these portfolios specifically. Portfolios that are overweight growth stocks, which is what technology is, and they are frequently ESG highly rated stocks, were particularly hit hard. And therefore there is a need because the oil price volatility and potentially trend of higher oil prices is likely to continue longer run without even a specific war in happening. All of the oil issue needs to be looked at as far as hedging is concerned. And we think we have some specific ideas here at Newday. But with regards to growth versus value, all you have to do is look at the value index versus the growth index, which outperformed by double digits. So this is just a trend that occurred this year due to interest rates, and it looks like we're at the end of that cycle. So 2023 is a new day, no pun intended, and a positive one where we seem to be coming to, as I said, the end of this interest rate cycle, at least in the near term.
It sure looks like it. And now Newday Impact launched its Sustainable Development Goals ETF in September. How's the traction going with it? Are investors coming into the fund, and how can our listeners learn more about it?
So, Mitch, last year was a tough year in raising assets. It's an equity fund, and due to it's tough getting people last year to look at equities given what was going on in the market. So, but we're in conversations with several large strategic investors currently about the advantages of the portfolio. And the advantages have been recognized by an independent rating company called ESG. And it's been rated in the 99th percentile of its ETF peers. So we believe our work will attract investors as the markets calm. And you can look under Newday. We have a page on ETFs that's really part of our management of these. So we think long run SDGS will be doing quite well, both in its return profile and with investors.
Well, I wish you patience and grit. Thank you so much for spending time with us, Ann.
Thank you so much. I very much enjoyed this, Mitch, and I hope I'll see you again soon.
I hope so, too. We've been speaking with Ann Popkin, President and Chief Operating Officer at Newday Impact Investing. You can learn more about Newday Impact at newdayimpact.com. That's all one word, no spaces, no dashes, newdayimpact.com. Two important ideas stand out for me in this conversation. We're in a brief but critical period of consolidating what we've learned to improve the way we measure and report business risk from climate change. And of course, that involves a lot of debate, and the debate is healthy. Unfortunately, some of it's not necessarily very productive, but here we are, and it's time to deal with the question. The other thing is that investing for sustainable outcomes requires patience and the will to take the ups and downs of placing long-term bets in the face of growing business losses from increasing numbers of extreme weather disasters. Munich Re, a global reinsurance company, reports that climate-related losses in 2021 totaled more than $210 billion globally and $95 billion in the United States. Compare that with the 40-year U.S. average weather-related losses of $43.9 billion, and it's clear that today business must be prepared to weather at least twice the climate-caused losses of just a few years ago. That information is what ESG reports cover, and it's what investors in society need to understand when making decisions. It's beyond me why ESG critics are working to reduce our access to that information, but as Ann said, the momentum behind ESG reporting is strong, and I think we're going to see a lot of progress over the next couple of years. Of course, we'll be following it here on the show, so stay tuned. Folks, I hope you'll take a few minutes to share this show or any of the more than 360 episodes of Sustainability in Your Ear with your friends, family, neighbors, and coworkers. You folks are the amplifiers. You spread the ideas that lead to a less wasteful world. We can get people thinking about investing in companies that make a positive contribution to the future, not a negative one. Let folks know they can find us on Apple Podcast, Spotify, iHeartRadio, Audible, or any of the fine purveyors of podcast goodness you favor. In fact, if you could leave us a review, it would be very appreciated. That's the way that more people find out about us. I'm Mitch Ratcliffe. We'll be back with another innovator interview soon. In the meantime, folks, take care of yourself, take care of one another, and let's all take care of this beautiful planet of ours. Have a green day.